We've all been there. It's late, you're online, and you want something. You go to checkout, and you see that little button right next to the credit card form. 4 easy interest-free payments. Suddenly, a $60 decision feels like a $15 one. The pain of paying just disappears. But that button, it isn't your friend, a trigger for a machine carefully designed for one purpose only, to get you to spend the money you don't have on things you might not need. It works because it feels free, but it's actually funded by a single invisible transaction. A transaction most people have never heard of.
I don't know who thought giving loans on $12 Chipotle bowls was a good idea. These buy now, pay later services like Klarna are starting to fail fast.
This isn't just a feature, it's a playbook. A playbook that has created a multi-billion-dollar industry out of thin air. And to understand it, we have to do what old school journalists do. We have to follow the dollars. We are going to trace the path of a single $100 purchase through this entire system, through the banks, through the tech companies, to see where it really ends up. Our story starts with a shopper. Let's call her Carla. So Carla goes online to buy a $60 t-shirt. But when she saw that pay in 4 option, a thought crossed her mind. Since it's only an extra $10 per payment, why not? She adds a $40 pair of sneakers to her cart. The total now is $100. She clicks the button, approved.
Need a bucket or attachment before payday? You can now shop on the Rhinox website via Klarna.
And right there, before we even talk about fees or interest, we have uncovered the first secret of the buy now, pay later machine. It is designed to make you spend more. Studies show that shoppers spend anywhere from 10 to 40% more when they use these services. So on her mission to buy a t-shirt, Carla has already ended up spending $40 more. That's the first hidden cost of these machines. So Carla gets her shoes and the t-shirt, but what about the store? Do they get the entire $100?
If you're using the Eat Now, Pay Later feature on DoorDash, Uber Eats, whatever it may be, you shouldn't be allowed to have children. Your genes should not be able to be spread to offspring.
We shouldn't have more of you.
That's where we find that invisible transaction I mentioned. The answer is no. The buy now, pay later company takes its cut first. That's their primary fees. While the credit card company only charges anywhere from 2 to 3%, the BNPL fees is much higher, usually around 6%. So on this $100 purchase, the store doesn't get the entire $100. It only gets $94. $6 is paid to the BNPL company. The store is the first one to pay for your free purchase. So the store makes less and Carla spends more. But to really understand this machine, we have to look at the company in the middle. They just made $6. That's their first, most obvious play. And they have a simple backup plan. If Carla slips and misses a payment, they charge late fees. Another win for them. This is the brute force part of their business. But the real genius of this system isn't all these simple fees. It's how they use this first transaction to set up their next 3 moves. The second play is to stop being a simple payments tool and start being a bank. That interest-free promise that Carla got in the door, it often only applies to small payments. The real goal is to get her comfortable with the system, so that when she wants to buy something bigger, a couch, a plane ticket, a laptop, she'll choose their long-term financing. And on those plans, they absolutely charge interest, sometimes even higher than the credit cards. It's a classic bait and switch. But the most modern and perhaps the most powerful play in their book isn't about being a bank. It's about being a tech company. See, when the BNPL company sees Carla's purchase, they don't just see a transaction, they see a profile. They know what she likes, when she buys, how much she's willing to spend. And this data is pure gold. And that is how they cash in. Their app transforms into an advertising machine. They use her data to show her the products that they think she'll like. And when she ends up buying those, they get a commission from that other store. They're not just facilitating a sale anymore, they are creating a new one. But there's one last move, a master stroke. A way for them to make money even when all the other systems fail. Some of these companies can issue a virtual credit card for you to use, and when they do that, they get to collect that small interchange fees. And in that moment, they found a way to become the store's payment partner, the bank, the tech company, the credit card network, all at the same time. To understand the genius and the danger of buy now pay later machine, you have to understand what it's really competing with, the traditional bank. For 100 years, traditional banks have operated under a simple deal. They get the power to lend money, but in return, they have to wear a set of regulatory handcuffs. They have to follow strict rules designed to protect the consumer and ensure stability of the financial system. The founders of these new fintech companies looked at this model and found something profound. The most profitable part of the banking industry weren't the ones covered by the strict rules. So they decided to unbundle the bank. They cherry-picked the most lucrative part of this banking industry and left the costly, regulated parts behind. They built a new kind of bank, a bank without rules. They saw the billions that the banks and these networks make from transaction fees, so they created merchant fees, a supercharged version of the same. They saw the profits that the banks were making with personal loan, so they started offering long-term financing with interest, but often without the same rigorous ability to pay checks that the banks have to perform. And they saw the incredible profits that the banks make from the penalty fees. So they built a system where late fees is a central and important part of their business model. They took the revenue streams of a bank but wrapped them in the body of a tech company, allowing them to operate in the legal gray area. It is one of the most brilliant and disruptive financial innovation of the 21st century. So when you ask who pays for your buy now pay later, the answer is much more complex. The merchant pays with the hefty fees, you pay with your data, with late fees if you slip up, and with the powerful temptation to spend more than you otherwise would. And a multi-billion-dollar industry was born in that gap. It's a perfect modern transaction. It feels convenient. It feels like a choice. But the financial black box is designed to make you forget that nothing is ever truly free. And the most profitable systems are the ones that can convince you that it is.